Oil just crossed $100 a barrel. If you're wondering what that means for your wallet, your commute, and your investment accounts, you're in the right place. This is Money Moves Daily. I'm breaking down the financial impact of the U.S.-Israel strikes on Iran and what it means for everyday Americans trying to protect their purchasing power. Before we get into it, this is not financial advice. I'm here to give you the information. What you do with it is your call. Let's get into the numbers. Here's what you need to know. Gas prices have already spiked 19% in just days, and analysts are saying the all-time record price is now squarely in the crosshairs. We're talking about the possibility of $5 a gallon gas nationwide by spring. That would match the record set in June 2022, and this time, there's no stimulus check coming. So what actually happened? What's the real impact on energy markets? And more importantly, what can you actually do about it? That's exactly what we're covering today. Let's start with the timeline. On March 1st, 2026, U.S. and Israeli forces launched joint military strikes on Iranian targets. The energy markets responded within hours. This isn't just about geopolitics, it's about geography. 20% of the world's seaborne oil trade flows through a single chokepoint, the Strait of Hormuz. Think of it as the world's energy bottleneck. Ships carrying millions of barrels of crude pass through this 18-mile-wide channel every single day. And right now, that channel is a question mark. Here's the first number you need to remember. Brent crude oil, the global benchmark, surged past $100 per barrel when markets opened. At one point, it approached $120. West Texas Intermediate, the U.S. benchmark, jumped 8.6% in a single trading session. That's the kind of move that used to take weeks. It happened in hours. And that move hit the gas station almost immediately. The national average is now $3.54 per gallon. That's a 19% increase in just days. Now, the all-time record for national average gas prices is $5.02 per gallon, set on June 14, 2022. Analysts say that record is now in play. Let me put that in perspective. If you're filling a 15-gallon tank twice a month, every dollar increase in gas costs you an extra $360 per year. For families renting 2 cars, that's over $700 a year just from a $1 increase. And we could be looking at close to $1.50 more by spring, historically speaking. According to energy analysts, if oil prices average around $100 per barrel through the year, gasoline could reach just shy of $5 per gallon by the second quarter. But it's not just about gas. Oil prices ripple through the entire economy. Trucking costs go up. Shipping costs go up. And eventually, that shows up on price tags everywhere. Groceries, appliances, clothes, anything that moves by truck or ship could see price increases over the coming weeks. This is the cascading effect of an energy price shock. The stock market felt it immediately. S&P 500 futures dropped 0.8% following the attacks. Nasdaq futures fell by the same margin. European markets took an even harder hit. OSTOXX 50 futures fell 1.3%. Germany's DAX futures dropped 1.4%. Now, markets can be emotional in the short term. We've seen plenty of geopolitical crises that caused initial panic and then stabilized. But this situation has a unique risk factor. The Strait of Hormuz hasn't been blocked. But marine tracking shows tankers piling up on either side, unable to secure insurance for the voyage. That's a supply chain disruption in real time. NPR reported that market traders went from, quote, having ice in their veins to panic in their veins as prices shot up. That's a dramatic shift in sentiment. The administration has characterized the price surge as, quote, a little glitch. But history suggests that oil price shocks lasting more than a few weeks tend to feed into broader inflation metrics. And here's the thing, American consumers are already stretched. Credit card debt is higher than it was during the post-pandemic recovery. Savings rates have declined. This hits at a vulnerable moment. So what's the realistic range of outcomes here? Analysts are broadly projecting 3 scenarios, and each one has different implications for your monthly budget. Scenario 1. A quick resolution. If tensions de-escalate within weeks, gas prices might settle in the 350 to 375 range. That's elevated but manageable for most budgets. Scenario 2. Prolonged tension. If the conflict stretches into April without direct supply disruption, expect gas between 4 and 450. That starts to change behavior. Scenario 3. Supply disruption. If the Strait of Hormuz sees significant blockage or insurance markets freeze up, $5 gas becomes the base case, possibly higher. So what can you actually do right now? Let's talk practical steps. Not panic moves, but rational adjustments that make sense regardless of which scenario plays out. First, review your monthly budget assuming gas prices between $3.50 and $4 through summer. That's the new normal scenario most analysts project. Build that into your planning now. Second, if you've been planning a road trip or considering a large vehicle purchase, it's worth recalculating the economics. That cross-country drive might cost $200 more than you budgeted. Third, and this matters for investors, energy sector stocks have historically outperformed during oil price spikes. But let me be clear, past performance does not guarantee future results. Major integrated oil companies and domestic energy producers have historically seen share price increases during supply disruptions. That correlation has held in previous crises, but every crisis is different. If you're considering any portfolio adjustments, talk to a qualified financial advisor. Market timing is notoriously difficult, and chasing short-term trends can backfire. Fourth, consider your emergency fund. Higher fuel costs mean higher costs for everything that gets trucked, which is basically everything. Your cushioning might need cushioning. If you have a variable rate heating oil contract, now might be worth locking in rates before potential further increases. Fixed contracts provide certainty, even if they cost slightly more upfront. Now, I want to give you the bigger picture. Energy price shocks feel immediate and personal, because they hit your gas tank directly. But they also have second and third order effects. Airlines adjust fuel surcharges. Trucking companies pass costs to retailers. Retailers adjust shelf prices. The pain spreads outward like ripples from a stone dropped in water. The Federal Reserve watches energy prices closely because of exactly this transmission mechanism. If oil stays elevated, it complicates their inflation-fighting calculus significantly. That matters for interest rates, mortgage rates, and the broader credit environment. So even if you don't drive much, the ripple effects of oil prices touch your financial life. The smartest approach right now isn't to panic or make dramatic changes. It's to acknowledge elevated uncertainty and build a little more cushion into your assumptions. Budget conservatively. Maintain or increase your emergency fund. If you're invested in the market, ensure your allocation still matches your risk tolerance given current conditions. History offers some comfort here. Oil price spikes have happened before the 70s, the Gulf War, 2008. Markets eventually adapt. Supply eventually responds. But, and this is important, the adjustment period can last months, not days. Being prepared for a sustained period of elevated energy costs is the prudent move. Columbia CPA's analysis suggests that global energy impacts from this conflict could persist for quarters, depending on diplomatic developments and Iran's response to international pressure. The wild card here is Iran's response. Threats to block oil shipments are one thing, actual blockage is another. The difference between those outcomes spans a wide range of economic impacts. As an investor, this is exactly the environment where staying informed matters most. Following developments, understanding the range of outcomes, and maintaining flexibility in your approach. If this kind of analysis is useful to you, hit subscribe. We cover market-moving events like this every week, breaking down what they mean for regular people trying to build wealth. Let's zoom out for a moment. The U.S.-Israel strikes on Iran represent a significant escalation in Middle East tensions. Understanding why this particular conflict matters for energy requires a bit of context. Iran is a major oil producer, but more importantly, it sits next to the world's most critical oil transit route. That geographic reality is why markets reacted so sharply. About 1/5 of all seaborne oil trade, roughly 20 million barrels per day, passes through the Strait of Hormuz. Any disruption there reverberates globally within hours. This is why even the threat of disruption, not actual blockage, can move prices dramatically. Insurance companies become nervous. Shipping companies become cautious. Supply chains tighten. And that's exactly what we're seeing. Tankers anchored on either side of the strait, waiting for insurance clarity. Every day they wait is a day less oil reaches refineries. The speed of the market response was remarkable. Traders described the shift from calm to panic happening essentially overnight as the scope of the strikes became clear. This kind of volatility creates both risk and opportunity. Energy stocks often benefit from price spikes, but they also face regulatory and political pressures that can materialize quickly. For most individual investors, trying to trade around geopolitical events is a losing game. The professionals with faster information and execution will beat you to the move. The better approach: ensure your overall portfolio allocation still makes sense for your timeline and risk tolerance. If this situation makes you anxious, that's information about your comfort level. The coming weeks will bring more clarity. Diplomatic efforts are ongoing. The market will eventually find a new equilibrium, though that equilibrium might be at higher prices than we've recently enjoyed. The key is positioning yourself to weather multiple scenarios: conservative budgeting, adequate emergency reserves, and a portfolio you can hold through volatility without panic selling. If the record of $5.02 per gallon is matched or exceeded, it would mark a significant economic event, one that historically affects consumer spending and business planning. Businesses start postponing capital expenditures. Consumers cut back on discretionary spending. The economic ripples extend far beyond the gas pump. But, and I'll emphasize this again, we're in the early stages of this situation. The range of possible outcomes remains wide. Flexibility and information are your best tools right now. That's the situation as of today. Oil past $100, gas prices spiking, stock futures dipping, and millions of Americans recalculating their monthly budgets. The smart move isn't to panic, it's to acknowledge elevated uncertainty, build cushion into your plans, and stay informed as the situation develops. That's what separates smart money from scared money. This has been Money Moves Daily. Remember, this is education, not financial advice. For decisions about your specific situation, talk to a qualified professional. Until next time, stay informed, stay rational, and keep making smart money moves.